Welcome back to the Market Podcast. Asymmetric info for individual investors. Educational info only, not financial or legal advice. Consult a pro before investing.
Right now, the tech world has this single driving obsession: getting enough raw compute power for artificial intelligence. It feels like the biggest gold rush we've seen since the dot-com era.
It really does. And you'd naturally expect the giants, wouldn't you? Amazon Web Services, Microsoft Azure, Google Cloud. You'd think they just own this whole ecosystem.
But that's not quite what happened. The market's actually shown a pretty critical failure in how they executed, initially at least.
That's exactly the conflict here. In late 2023 and moving into this year, the whole world was desperate for the latest graphics processing units, the GPUs. But the big cloud providers, they were kind of caught flat-footed.
Why was that? Their infrastructure is massive.
It is, but that became the problem. It was designed as this sprawling generalist tool, good for everything: storage, databases, old legacy systems. But that sort of bloat and the long schedules they have for paying off older hardware, it meant they just couldn't pivot quickly enough.
Not fast enough for the kind of specialized, raw compute power that generative AI really needs.
Precisely. AI demands intense interconnectivity, pure power. The old model wasn't built for that specific intensity.
And so into that gap steps a company most people hadn't even heard of, coming out of all things, crypto mining. CoreWeave.
The definition of a scrappy upstart. Through sheer focus, rapid execution, they managed to quietly corner a big slice of the market by getting their hands on NVIDIA's most sought-after chips.
And they don't have any of that legacy baggage. They're just pure compute power designed for this moment.
That purity is what let them run this. Well, what we're calling the GPU arbitrage play. It sounds complex, but it's actually stunningly simple and brutally effective.
Explain that arbitrage.
Secure the best hardware, those NVIDIA chips, in huge quantities, often getting deep discounts nobody else gets. Then lease the data center space and rent out that compute capacity on demand to all the AI developers clamoring for it.
Okay, and this is where the numbers start to look, frankly, unbelievable. It creates this huge challenge for the hyperscalers. CoreWeave's gross margins on this GPU rental business, they're running around 74%.
74%. Now, compare that. You look at the big integrated players like AWS, even their specific margins just on GPUs might be, what, 20, maybe 30%?
So CoreWeave is operating at 2, maybe 3 times the efficiency on that specific hardware.
It's just an unprecedented margin shocker for the cloud industry. It's a clear signal that right now in the AI supply chain, specialization is absolutely dominating generalization.
So that really sets up the core question for us today, doesn't it? Can this specialized edge, this incredible margin advantage, possibly last? Especially when the hyperscalers, with their almost infinite resources, start sharpening their claws and try to copy this exact model brick by brick.
That's the fundamental investment battle playing out right now. Can the focused innovator hold off the scale of the incumbents?
Before we get into whether that advantage can hold, let's look at where they came from. The credibility behind this kind of rapid market-shaking rise is important. This isn't some typical Silicon Valley startup. It's more like a phoenix rising story.
It really is a phenomenal case study in adapting. The company actually started back in 2017. It was called Atlantic Crypto then, founded by 3 guys from Wall Street, quants: Michael Intrater, Brian Venturo, and Brandon McBee.
Right. The Wall Street background is interesting.
They pooled about $4 million, went all in mining Ethereum, and they did well for a while.
Until the crypto crash of 2018. That must have been an existential moment.
Oh, absolutely brutal. The crash basically left their huge collection of mining rigs completely idle. What looked like maybe a $50 million valuation just evaporated. They were staring failure right in the face.
But crisis forces change.
It forced a pivot in 2019 that turned out to be incredibly prescient. They realized, wait, this hardware isn't useless, it's just sitting here. They looked at the machine learning community, which was just starting to really take off, and saw this intense need for compute power that nobody was properly serving.
So they took their idle mining rigs?
Repurposed them.
Yeah.
And made a really critical, bold bet early on, securing the early NVIDIA A100 chips, specifically aiming them at machine learning rentals.
Turning that potential disaster into a launch pad.
And the numbers really show it. That pivot directly led CoreWeave to achieve this mind-blowing 400% revenue compound annual growth rate, that's CAGR, from 2022 projected out to 2025. It wasn't luck. It was evolution forced by crisis, which made them incredibly nimble and obsessed with maximizing hardware use from day one.
Okay, let's look at the leadership driving this. That founding trio seems highly aligned, and that internal cohesion feels key to their aggressive strategy.
You really have to look at the three key players. Michael Indrater, he's the CEO, the visionary dealmaker. His focus isn't quarter to quarter, it's this 10-year AI wave. He was the one driving those absolutely crucial multi-billion-dollar deals with giants like OpenAI and Microsoft.
Those are huge anchor tenants.
Huge. Those two deals alone now make up over 70% of CoreWeave's revenue. So Intrater's strategy is about locking up massive, predictable demand for years to come.
But having the deals is one thing. Scaling the infrastructure to meet them requires serious operational muscle. That falls to Brandon McBee, the Chief Development Officer.
Right, McBee is the infrastructure general, you could say. His team is overseeing deploying over 250,000 GPUs across 33 data centers. That scale-up is impressive in itself, but the really innovative part is the financial engineering behind it.
What do you mean?
McBee negotiated $13 billion in debt financing, but it's specifically GPU-backed lending. This is a novel approach. It let CoreWeave raise capital and buy hardware much, much faster than rivals who have to rely on slower, more expensive, and frankly, shareholder-diluting equity fundraising rounds.
That's a significant financial edge. And the third founder, Brian Venturo.
Venturo is the Chief Technology Officer. He's the architect of the technical engine, the software that actually makes this all work so well. We'll get into the details, but his proprietary Kubernetes native stack for orchestrating the GPUs, that's the secret sauce. It's what maximizes the hardware utilization and delivers that performance edge.
And for you, the investor, that founder alignment is critical. Intrater still holds about 15% equity even after the IPO. Decisions seem genuinely founder-led, prioritizing the long-term AI opportunity over just hitting the next quarterly target.
That long view directly explains their strategy of GPU hoarding. They don't just buy chips reactively, they stockpile these critical assets, often getting them 20 to 50% cheaper than rivals who are scrambling in the spot market later.
It's a builder's mentality.
Exactly. And that culture translates into execution speed, too. There's that anecdote about the 2024 cluster build for Mistral AI. CoreWeave engineers didn't just manage it remotely. They physically camped out at the data center site to shave weeks off the deployment time.
That level of hands-on service.
You're just not going to get that from the internal bureaucracy of a massive hyperscaler. It's a different culture, different focus.
Okay, so if that leadership and culture are the engine, the GPU arbitrage is the incredibly potent fuel. Let's make sure we break down exactly how this business model works, keeping the individual investor in mind.
Right, at its core, the model is pretty straightforward. Think of it almost like an Airbnb for GPUs. They secure the premium NVIDIA chips in enormous volumes. That's the arbitrage part. They lease the physical data center space. Then they rent out the computing power on demand. But the key difference is focus.
You drew the analogy earlier. AWS is the Swiss Army knife for all cloud needs, storage, email, whatever. CoreWeave is more like a laser-focused scalpel, designed and optimized only for the compute-hungry heart of AI training and inference.
That extreme specialization is the only reason those 74% gross margins are even possible. And that success rests on three interconnected pillars, three strategic features that create their initial advantage.
Let's break those down. Pillar one is the economic engine, the arbitrage itself. How exactly do they command a 74% gross margin when competitors struggle to hit 30% on the same hardware?
It boils down to getting the chips at prices others can't access. CoreWeave has this deep, long-standing relationship with NVIDIA. They commit to huge volume purchases years ahead of time. This often lets them bypass the usual distributors and get closer to wholesale pricing.
So they get the chips cheaper.
Cheaper, yes. And because AI compute demand is so incredibly intense right now, they can charge a premium for access to that scarce resource. That 74% margin reflects perfect market timing combined with preferential supply chain access. It results in margins that are just exponentially better than a general-purpose cloud business, even an optimized one.
Okay, pillar two isn't just about the hardware itself, but the software layer that makes it perform so well.
This is Brian Venturo's domain, the software moat. You see, traditional hyperscalers have multiple layers of software virtualization, hypervisors, complex internal stacks to manage all kinds of different customer workloads. That's necessary for a generalist, but it adds latency overhead.
And CoreWeave cuts that out.
Because they only do AI compute, they can. Their environment is built on a bare metal Kubernetes native stack. It's perfectly tuned just for GPU orchestration. They eliminate those extra layers that slow things down for AI.
And what does that mean in practical terms for, say, a company training a large language model?
It means better efficiency and more reliability. Their software maximizes how much the GPUs are actually working, achieving an industry-leading 96% cluster goodput. That's useful work done, not wasted cycles. It also means they can spin up capacity for inference tasks 10 times faster than rivals.
That speed matters.
Critically, for an AI developer, this technical design translates to about 50% fewer interruptions compared to running the same job on a more complex legacy hyperscaler setup. That means faster model training, faster deployment to market. Time is everything in AI development.
And the third pillar locks in the future value, those massive customer contracts.
This provides incredible stability. That lock-in is quantified by the $30.1 billion revenue backlog they currently hold. And that number is up a staggering 86% just year over year.
This isn't just projected revenue, it's contracted.
Exactly. It's highly predictable recurring revenue. It makes up nearly 90% of their expected future income, and the contracts average over 4 years in length. This gives them phenomenal financial visibility, stretching out towards 2030 and even beyond.
Concrete examples.
We're talking about OpenAI's $11.2 billion contract, Meta's $14.2 billion deal. These agreements extend all the way through 2031. For an investor, this is essentially guaranteed revenue booked years in advance.
And operationally, how do they scale so fast without just drowning in capital expenditure for buildings?
That's the elegance of their lean asset-light model. CoreWeave doesn't own the data centers themselves. They lease all the space from partners, big players like Saracen.
So they avoid the massive upfront cost and time of building.
Precisely. This asset-light approach gives them extreme agility. They can deploy huge new GPU clusters in just days. Compare that to the months it takes a vertically integrated giant like AWS to design, build, and commission a new cell-phone facility.
And that translates to cost savings, too.
Big time. This operational flexibility results in roughly a 50% lower total cost of ownership compared to traditional cloud infrastructure builds. It's a key enabler of their explosive capital-efficient growth.
Okay, that leads us directly to the financial reality check. We have this explosive top-line growth, these amazing gross margins, but it requires absolutely massive investment. It creates this financial roller coaster. You, the investor, really need to grasp why they can be losing money on the net income line while simultaneously dominating their niche.
The top-line growth is undeniable. Their guidance for full year 2025 revenue is $5.25 billion. That's 174% growth. Just look at the second quarter of 2025. Revenue hit $1.21 billion, up an incredible 207% year over year. They are absolutely seizing market share at speed.
But reconcile that with the bottom line. Those 74.5% gross margins are world-class, yet they reported a significant net loss in Q2. Where does the money go?
That's the crucial point to understand. While the gross profit on each GPU hour rented is fantastic, the company is operating on an invest for dominance principle right now. We see this clearly when operating margins drop dramatically down to around a 4% reported operating margin, or maybe 7% on an EBITDA basis.
So where's the disconnect between gross and operating profit?
Most of that difference comes down to two massive factors hitting the income statement hard. First, what you could call the CapEx vortex.
The spending on new hardware.
Exactly. They are pouring every dollar they make, plus billions more from financing, straight back into acquiring the next generation of GPUs. They're projecting a $23 billion capital expenditure budget for 2025 alone. That's enormous.
And that spending hits the books immediately.
Well, the depreciation on that new hardware hits immediately, and the interest costs on the debt used to buy it hits immediately. Together, those contribute directly to that Q2 net loss figure of $290 million. It's like maxing out your credit cards to buy inventory. Will sell out instantly. But the cost of financing that inventory shows up on your statement today.
And the second big factor is that $20 billion debt position itself, the leveraged bet we talked about.
That debt creates a very significant fixed financial drag on the company. That $20 billion carries an interest cost that amounted to $267 million just in the second quarter.
Wow, that's a huge chunk of revenue.
It is. It means you see 19% of their total revenue is going straight out the door just to service the debt. This intensely pressures the net income figure. So an investor just looking at the bottom line net loss without understanding the context of this massive strategic investment phase is really missing the bigger picture.
But despite those net losses, there's still an incredibly strong signal of market demand that seems to validate this aggressive spending strategy.
Absolutely. That signal is their Rule of 40 score. It's a common metric in tech, especially software as a service, but it applies here. You add the growth rate to the profit margin, in this case, the EBITDA margin.
So CoreWeave's rule of 40 is?
It's their 174% revenue growth plus their 7% EBITDA margin, which gives you a stunning 181%.
And how does that compare?
For context, a healthy growing SaaS company usually aims for 40% to show good product market fit and efficient growth. A score of 181% is just off the charts. It's a textbook indicator of hypergrowth. It signals that the market's demand for their specialized service vastly outweighs the short-term financial burn required to capture that share.
And putting that growth alongside competitors really highlights the arbitrage advantage.
It does. Those 74% gross margins absolutely crush competitors like Lambda, another specialized provider, who operate closer to 50% gross. And they blow AWS's estimated GPU hosting returns out of the water. But again, you see the trade-off. Dominant gross margins, but unavoidable net losses for now, trailing way behind AWS's stable, mature 25% overall operating margins. CoreWeave is consciously trading short-term stability for long-term speed and market dominance.
Which brings us right back to that central risk. Can CoreWeave possibly build its fortress quickly enough? Can they withstand the inevitable aggressive copycat moves from giants like AWS and Azure, who are definitely scrambling now to catch up in this specific AI niche? We need to really examine the competitive advantages, the moats they're trying to build.
Okay, the single biggest defense they have is the one we keep coming back to. Their cornered resource position through those deep ties with NVIDIA. This isn't just a friendly vendor relationship. It's a strategic, symbiotic partnership, giving them first access to the most critical resource in this entire market.
What does that access mean practically, like with the newest chips?
It meant, for instance, they were scheduled to be the very first cloud provider to deploy NVIDIA's latest Blackwell GPUs back in July 2025. Even more crucially, that relationship allowed them to secure $4 billion in pre-orders for those chips. That locks in supply and slashes their hardware costs by maybe 20 to 30% compared to rivals who are forced to fight for allocations later in the spot market.
That kind of supply chain access and trust.
You simply cannot replicate that overnight. It's been built over years. It acts as a massive barrier to entry for anyone trying to compete purely on NVIDIA hardware access right now.
They also seem to have a structural advantage just by being different, what you called counterpositioning, against the hyperscaler model itself.
Definitely. That AI-only purity we discussed allows them to run that super efficient bare metal Kubernetes environment. Because they don't have to support email servers and databases and 1,000 other things, their infrastructure is streamlined. The result? About 50% fewer interruptions for those critical AI training runs.
And that reliability and speed is what customers value most.
It seems so. When Meta signed that huge $14.2 billion deal, they specifically cited CoreWeave's unmatched speed and reliability as key factors in their decision. Being purely focused allows them to optimize for what AI needs most.
And once a customer like Meta or OpenAI signs those multi-billion, multi-year contracts, switching becomes incredibly difficult.
The switching costs are enormous, both financially and logistically. Think about OpenAI's $11 billion backlog. That confirms how locked in they are. Imagine you're midway through training a massive, cutting-edge AI model. Switching your cloud provider would be a nightmare.
Why specifically?
It wouldn't just cost millions in wasted compute time already spent, it would likely set the entire project back by weeks, maybe months. You'd risk missing crucial market windows for deploying your AI. The combination of data gravity moving huge data sets is hard, and CoreWeave's customized, sticky software stack just makes migration far too painful and risky for these major clients.
Beyond the partnerships and the software, they've also started integrating vertically where it boosts efficiency, right? Like the Core Scientific acquisition.
Yes, that $9 billion acquisition of Core Scientific in July 2025 was a very strategic move. Core Scientific came from the crypto mining world. Their sites are already designed for exactly what CoreWeave needs: massive power consumption and high-density computing.
So CoreWeave gets purpose-built facilities.
Exactly. Integrating these sites boosts CoreWeave's data center density. They're talking about 100 kilowatts per rack, which is very high, and improves overall energy efficiency, maybe by 40%. It helps them achieve that 96% utilization rate, which is far better than the roughly 70% you might see in more generalist data centers. They bought infrastructure perfectly suited for their specialized needs.
And finally, maybe the simplest but most powerful differentiator for the customer is just plain speed of execution.
It's the speedboat versus the battleship analogy again. CoreWeave can deploy massive, new, optimized GPU clusters in a matter of days, We've seen examples where it takes a giant like Google Cloud Platform months to provision something comparable, if they can even get the required chips.
That agility is hard to replicate.
It's incredibly hard for a large, complex organization. The internal governance, the bureaucracy, the multiple layers of approval within a hyperscaler just cannot match CoreWeave's focus speed. This pace itself discourages replication because the time-to-market advantage CoreWeave offers customers is just too significant.
All right. We've laid out the explosive growth, the potentially formidable moats, but now we have to confront the final decision point for you, the investor. The company carries a $70 billion market cap based on $3.5 billion in trailing 12 months revenue. That's a price-to-sales multiple of 20 times. High by traditional standards. Is this the infrastructure story of the AI decade, or is it a house of cards built on $20 billion of debt?
We absolutely have to steelman both sides of the argument here. Consider the bear case, the biggest risks, very seriously first.
And the most glaring risk has to be customer concentration.
It's definitely high on the list. That reliance on just a few massive customers is inherently risky. Microsoft alone accounts for 62% of their revenue. The top 3 customers combined make up 80%.
What's the danger there?
If just one of those giants, let's say Microsoft, decides to significantly reduce its reliance on CoreWeave, maybe because they build out more internal capacity or shift strategy, well, that would create an immediate, potentially catastrophic cliff edge for CoreWeave's revenue stability. There's very little diversification right now.
And then there's the debt. We keep coming back to it. But investors have to see that $20 billion debt bomb as a constant underlying risk.
It's a colossal risk, no question. That level of debt translates directly into $1.6 billion in annual interest payments. That's a guaranteed massive drag on the bottom line. It could easily balloon those net losses, especially while they're also spending tens of billions on CapEx each year. This strategy is highly leveraged. It requires continued near-perfect execution. There's very little room for error or for a significant economic downturn impacting AI spend.
Bears also worry about the moat itself eroding, specifically the fear that the GPU supply bottleneck eases, killing those amazing margins.
That's a major bear thesis point. The argument is that post-2027, as NVIDIA and potentially others dramatically ramp up chip manufacturing, the scarcity premium that CoreWeave currently benefits from will simply evaporate. Competition heats up, supply catches up with demand.
And margins compress.
Margins would likely compress significantly, perhaps falling from the current 74% down towards more traditional cloud infrastructure levels, maybe closer to 20 or 30%. That would completely change the financial profile.
And the hyperscalers aren't standing still either. They're developing their own chips.
Exactly. Institutional bears are pointing warily at the hyperscalers aggressively pursuing internal replication using their own custom silicon. Think about AWS's Trainium chips, now on version 3, or Google's TPUs.
How does that custom silicon specifically threaten CoreWeave's model?
CoreWeave's entire expertise, their software stack, it's all built around optimizing NVIDIA hardware. If a huge customer like Microsoft or Meta starts shifting significant internal AI workloads onto proprietary chips designed in-house or by AWS or Google, well, CoreWeave's specialized offering becomes irrelevant for that specific part of the workload.
And those custom chips could be cheaper.
Potentially, yes. Bears argue this custom silicon could undercut CoreWeave's pricing by as much as 30% for certain tasks. That competitive pressure, combined with margin compression, is why you see some pretty aggressive bear targets for the stock price, sometimes down in the $80 to $100 per share range.
Okay, that's a compelling bear case. Now let's flip it. Steelman the bull thesis. Why do proponents see this as a potentially generational investment opportunity?
The core bull argument often frames this moment as being similar to Amazon Web Services back in 2006. The idea is that these early net losses aren't a sign of failure. They are the necessary strategic cost of building a dominant, defensible moat in a brand new, exponentially growing market.
And the backlog provides the safety net.
The $30 billion backlog is absolutely paramount to the bull case. It provides immense stability and visibility. It effectively de-risks a huge chunk of their future revenue stream all the way out to 2030. Bulls see this converting into roughly $6 billion of highly predictable annual recurring revenue, and crucially, it's locked in at those current, very high 74% gross margins.
Bulls also argue the speed and technical edge are a moat the giants just can't easily cross.
They emphasize the combination of the privileged NVIDIA relationship and that highly optimized software stack. Together, these provide a verifiable 10-time speed advantage for deploying new clusters, plus superior hardware utilization. This isn't just nice to have. It makes CoreWeave's platform incredibly sticky for customers running demanding AI workloads.
And how does this translate into valuation from the bull perspective?
From a valuation standpoint, bulls run discounted cash flow models. They project forward based on converting that massive $30 billion backlog into actual revenue, perhaps reaching $20 billion annually by 2028. Based on those projections and maintaining strong margins, these DCF models tend to suggest a conservative fair value range for the stock around $180 to $220 per share.
So significantly higher than the current price.
Yes, which is why bullish price targets often push even higher, sometimes towards $200 to $250 per share, implying substantial potential upside from current levels.
Okay, we've heard the bear case, we've heard the bull case. Synthesizing this very polarized view, what seems like the most probable outcome right now? And how should you, the individual investor, think about the stock's current price point?
Well, looking at institutional consensus, particularly from analysts who closely track the NVIDIA supply chain dynamics and the quality of these large contracts, the sentiment definitely leans bullish right now. You could probably put a rough probability on it, maybe 70% weighted towards the bull case holding for the medium term.
Why that leaning?
Primarily because the sheer scale and the long-term visibility provided by that $30 billion backlog, combined with the seemingly ironclad NVIDIA relationship, appear to outweigh the very real debt risks, at least for now. The market seems comfortable paying a premium for what looks like a guaranteed high-margin revenue stream extending out for several years.
And looking specifically at the price today versus that perceived value.
With the stock recently closing around the $140 mark, it's trading at roughly a 15% discount to the midpoint of those typical DCF valuation ranges we mentioned, $180 to $220. This suggests there might be a measurable margin of safety baked in, offering potential for outperformance if they continue to execute well.
So the market is favoring the backlog story, but acknowledging the risks?
Exactly. The market believes in the long-term conversion of that backlog, but it absolutely requires CoreWeave to maintain flawless execution, especially in managing that significant debt load while continuing to invest heavily.
So let's try to summarize the core tension here. Short-term, CoreWeave's specialized GPU arbitrage model is generating operating profits per GPU that are maybe 2 to 3 times higher than what AWS makes on its GPU business. That's the edge.
That's the current reality.
But long-term, sustaining that massive edge requires continuous, perfect execution. They have to keep building that fortress faster than the giants can replicate their specialized model.
The replication is coming. AWS, Azure, Google. They are not standing still. They are throwing immense resources at catching up in specialized AI infrastructure. But what might truly distinguish CoreWeave, and perhaps what you, the individual investor, should focus on even more closely, are the less obvious financial mechanics providing an asymmetrical edge, an edge rooted, interestingly, in their origins.
What specific hidden mechanics are you referring to beyond the usual metrics?
It's that unique financial mechanism we touched on earlier, the GPU-backed lending structure. This model is allowing CoreWeave to finance roughly 80% of its massive capital expenditures at a competitive interest rate, maybe around 7%.
And why is that unavailable to the hyperscalers?
It's largely unavailable because of internal governance and how they structure financing. Hyperscalers typically finance broad infrastructure plans, not specific batches of hardware collateralized by specific customer contracts in the same way. CoreWeave leverages the fact that their inventory, the NVIDIA GPUs, isn't just expensive hardware. It's highly valuable, relatively liquid collateral. More importantly, it already has multi-billion-dollar long-term rental contracts attached to it from blue-chip customers like OpenAI and Meta.
So banks see it as lower risk.
Banks view this as an extremely safe, almost guaranteed future revenue stream tied directly to specific, valuable assets. That makes them comfortable lending huge amounts using the future revenue generated by those specific chips as collateral. This financial innovation significantly boosts CoreWeave's return on invested capital compared to competitors who have to rely more heavily on slower, more expensive, and dilutive equity financing. It's a hidden financial accelerator.
That's fascinating. And you mentioned a connection back to their crypto mining origins.
Yes. That history, particularly the acquisition of Core Scientific's assets, positions CoreWeave uniquely for potential future hybrid compute models, maybe combining AI workloads with something like Bitcoin transaction processing or mining during off-peak times.
No, would that work?
They now own these high-density data centers already optimized for intense power usage. This infrastructure could allow them to capitalize on energy arbitrage, Imagine running lower-value, energy-intensive tasks like crypto mining when AI compute demand dips temporarily, or when electricity prices are very low overnight. Then instantly pivot back to high-value AI compute when demand spikes or energy costs rise.
So maximizing utilization and potentially profiting from energy price swings.
Exactly. Some analysts suggest this specific capability, this potential for hybrid utilization and energy arbitrage rooted in their mining DNA, is currently undervalued by the market. It might represent a potential $500 million valuation uplift that isn't fully priced into the stock yet. It's another layer to their potential efficiency edge.
Okay, so wrapping this all up, what's the single most actionable idea or metric that an individual investor should take away and track going forward?
Beyond the headline revenue and margins, individual investors absolutely must track the backlog additions reported each quarter. The upcoming third quarter earnings release, likely in late October, will be critical here.
What should we look for in that backlog number?
Strong, continued growth in the backlog, big new contracts being signed, signals that their competitive moat remains deep, and crucially, that NVIDIA's commitment to providing them preferential access and pricing remains unwavering. That's the bull case playing out.
And conversely,
Conversely, any significant slowdown or dip in backlog growth could be an early warning sign. It might signal that the copycats, the hyperscalers, finally getting their specialized AI offerings in order, or maybe deploying their own custom silicon effectively, are beginning to succeed in chipping away at CoreWeave's advantage.
so the backlog trend is the canary in the coal mine.
It's a key indicator. In this AI gold rush, owning the infrastructure the shovels is clearly vital. But CoreWeave's technical specialization is one edge, and perhaps just as importantly, their unique GPU-backed financing structure is the hidden accelerator. Watching how effectively they maintain that backlog growth will tell you if they can truly remain the master of this high-stakes arbitrage game.
Love this? Drop a like, subscribe, and ring the bell so you never miss a podcast.